Welcome to the Perspectives on IBC series, where advisor Chris Tormey joins me in a discussion on all things related to the infinite banking concept. In this educational series, you'll learn the basics of IBC and how you can recapture the financing function in your life so you can gain more control and freedom of your wealth. So welcome to the episode. We're on episode 7. Unbelievable. I'm here with my good friend here, Chris Tormey. We're on episode 7 of the foundations of the infinite banking concept. So if you stayed with us thus far, hopefully you have. We covered an interesting topic last time, buy term, invested difference. If you haven't listened to that, I would highly encourage you to go listen to that. It's one of those myths out there, But today we're going to cover something that I think for both Chris and I, there's some strong meaning towards, because all the great strategies around the infinite banking concept, how you can use it during your life to boost your wealth and store cash efficiently. There's another angle to it, is to help sort of benefit the future generations and passing on wealth. And for a lot of folks that does matter, and certainly for myself and Chris, it definitely does. So we're going to talk a little bit about more how that works, and give you some food for thought around how you could think about it if that's important to you. So Chris, welcome to the show today.
Thanks so much, Tom. I appreciate it. Looking forward to the conversation.
Yeah, it's certainly, as we're getting older, I think the fact of reality sets in. I think I see more people passing on a given week, and maybe I'm just more tuned to it than ever. And I do care about passing on, and I kind of call it a kind of a domino effect, like the things that we do, regardless of our dollars, but the impact that we have to our families, to people around us, that matters, right? And a lot of people, I think, matters, and the impact you can have down the road. But today, we're going to talk more about how IBC sort of helps with the wealth transfer. And so, Chris, why don't you give some initial thoughts around it and how you think about this?
Sure. Thanks, Tom. So this conversation is around one of the modules in the Nelson Nash's Institute. As we're doing all these conversations are around those modules. This one's particularly fascinating to me, and it's David Stern's story around how his family, 4 generations, is using whole life insurance to flow through the different generations, because David Stern's father is Nelson Nash. Father-in-law, sorry. David Stern's wife's father is Nelson Nash. And how wealth can flow through these 4 generations, how things can be systematized and set up. And he really shows the pictures of the actual children and grandchildren and what he's actually done to set up legacy for Nelson, for himself, for his own children, and how that all connects and makes tremendous amount of value and relationship, I would think, to all these different people. So we're talking about Nelson and his wife, David Stearns and his wife, who's Nelson's daughter, their 4 children, and their 12 grandchildren. So you're talking about a conversation around 20 different people spanning 85 to 90 years in age.
Yeah, and that's why, and a lot of it obviously starts somewhere, and usually is obviously for people who are listening who are considering this, starting with, in this situation, grandparents, right? If you're talking about, and actually great grandparents potentially. So usually starting somewhere, and for me personally, it's obviously me being a parent starting it, but thinking about future generations of grandchildren and great grandchildren to set this up. But it's got to start somewhere, and in this case, it was Nelson Nash who kind of started it, right?
Yes. And to get personal a bit, so my father got whole life insurance as he was exiting the Navy. They literally had a table set up as he was being discharged at the tail end of World War II. And I have it. I can share it with you at some point. It's basically, I think it was about $10 a month. and it was a 20 pay structure. So that's $120 over 20 years, so $2,400. And when he passed in 2018, my sisters and I were paid about $50,000. So 2,400 became 50,000 over those years. So there's your power of tax-free compounding. Now, my father never mentioned that. I found that life insurance after he passed, and that 50,000 was split between the three of us along with his other assets. So he certainly didn't use life insurance. He probably maybe forgot about it himself. So he didn't use it during the course of his life, but it was astounding to me. I did the math. I think it was around a 6.5 or 6.7% annualized compounding tax-free return. But that inspired me and I was already in this financial planning practice, of course, in 2018, but it inspired me to have whole life insurance on all four of our children. And so, as well as, of course, myself and my wife, Carolyn. So we've started the process that David Stearns talks about. Our children are not yet married, but we've set them up. Two of them are working already in their careers. So they've taken over the premium payments. And that's something that Stearns talks a lot about, is you start as the older generation funding these policies and getting them going. The insured, of course, is the children when we're talking about generational stuff, but the owner is the funder in the beginning, but then the ownership is transferred over or at least the funding. You could start ownership there if they're 18 or older, but you can transfer for ownership later once they reach age of majority. And then the older two have used their whole life insurance cash value 4 or 5 times already. Believe it or not, they're in their mid to high 20s. The younger two have not yet, and we continue to fund the younger two's life insurance. But it's an exciting journey, and it was really nice to see 4 generations and the conversations that having these assets, because we set it up for them, it's just part of our relationship now. We'll be taking a trip together in June, the 6 of us, and that'll be one of the conversations, one of the evenings around how we're all moving forward in our thinking relating to wealth.
Yeah, and it's amazing because it goes back to one of the kind of core ways of thinking about things is thinking long term. And obviously in the situation that you've done for your family and what I've started doing for mine is that we've started this sort of process and system that will span multiple generations of our family. And it has to be someone who instigates it or starts it and realizing for you, it was your father and, you took the baton and moved on. But when you're starting to do this and protecting yourself first, right, that's primary, and hopefully learn to use it and, getting your kids also involved, it's interesting to think that, that putting policies on your kids and most people may not, would never even thought to even consider that, but you've inadvertently protected your grandchildren before you knew it, before they're even born. And this is what this whole system itself can help perpetuate is this sort of wealth storage of wealth over multiple generations. And that's what, David Stearns sort of showcases in this module that, 4 generations using a system together can, safeguard a lot of wealth and allow them access to money that they can use for whatever purpose, education, building businesses, and becomes their own little ecosystem. It takes time for sure. But the really great part about it, which I think you've probably seen, Chris, in your world, is it facilitates tremendous conversations between your family because, you're asking people to learn about, the concepts of financing and the importance of investment and being good stewards in our wealth. And then secondarily thinking, how do we help our next future generations as they come in have not only the financial education, but some resources to kind of live out their dreams.
Absolutely. And you start to investigate feelings and emotions between, you and your loved ones. Like, I'll never forget when I first suggested it for our eldest son. Carolyn, my wife, was like almost in a panic because just the idea of one of our children passing away was sort of anathema to anything she wanted to even think about. And I remember her saying something like, I couldn't touch that money if he died, as if somehow the life insurance was causing some problem, which is absolutely not the issue. But I guess I'd suffice to say that there's a lot of emotion built up around the conversations of life and death, vis-a-vis everyone, but certainly around your closest loved ones, your own family, parents and children. So to come to terms with that is an important thing to do, to talk about, well, wait a minute, this is really there because what would our careers look like if we lost a child? Would our careers just recover in a week or a month or even a year? Probably not. So there's life insurance in place to basically protect against something catastrophic that could happen in the family, but also, and this is the emphasis with David Stearns, also start to develop those conversations around wealth and wealth growth. So let's talk about the 99.9% chance that no one passes away except the eldest generation and many years from now. And the younger ones are using that for wealth conversations rather than death conversations. But it does loom there in the background. I remember Nelson saying, that's just the reality of the risks of being alive is dying at some point. And it does happen. And so that brings up that conversation as well.
Yeah, and it certainly is a potentially touchy subject, but the ironic part about it, I think when we kind of mix between finance and death, I think more people are less comfortable talking about finances than dying.
Which in some cases, yeah.
Which is a crazy. So it's a sensitive topic, but to put it in very, very practical terms, and you shared it with your family. For mine, same is we've started this journey for my wife and I, and certainly that's where I'd say you start for yourself and for your spouse if you have one. And then, if you have the ability to put policies on your children, and mine, I started when they were born. I literally started and put policies when they were born. And so if my kids, 2 boys, ever have grandchildren, then that's where we'll step in as grandparents and fund their policies to get them started. And the flow should work, or would like to work, is, when my wife and I ever graduate from this earth, that the proceeds go to my children and they fund their grandchildren. And it kind of keeps on going down, skipping that generation as we move forward. And so that's the way it's one option of way it can work. And I think that's what's illustrated. I know you can't we're not showing anything in this podcast, but hopefully that made sense as I kind of walk you through it.
Well, Tom, I have a question about that. So there's 3 named parties in every life insurance contract. And one person can only be 2 of those 3. Never can you have one person be all 3. So there's the owner of the policy, and the owner typically is also the contributor to the premiums. Then there's the insured. So that's the life that's being insured. And if that life ends, the death benefit is paid. And then the third is the beneficiary for that death benefit. So how did that work vis-a-vis you and the kids? Because mine were pretty much adults. So what we set it up for us, where we're funding it, 2 are owning their own, 2 now own their own as well because they're now in age of majority. And then beneficiaries come back to us at this moment in time. But how are you changing ownership and funding responsibilities with your own family, or talk generally about that?
Yeah. Obviously, as minors, right? Kids, newly born, right? They don't really know much about anything but a few things, eating and sleeping, maybe. But yeah, so my wife and I owned the policies when we first created them, obviously on the life of our children, and the beneficiaries were us until we, got into establishing our own trusts. So right now, our trusts own the policies, and our kids are the insured. And then down the road, we will transfer that ownership of the policies to our children when they become of age and have shown responsibility around, owning their futures or lives, careers, and then they would start funding it for themselves. So that transfer will happen as they age, like you've already described for your family, in due time as they get older. But for now, we own it, we control it, we dictate what happens to it, and down the road, as our kids grow older, then they'll take on that responsibility.
Beautiful. That's great. And the things that we learn when we're looking at generational policies is just how incredibly inexpensive life insurance can be for the very young. And that brings up the topic of, can you age out of the IBC concept, the infinite banking concept? Is there an age at which, you just can't do it anymore? And that is the next module of the conversation. I don't know if you want to talk a little bit about that or
Yeah,
keep
sure. Yeah. I think it's always a common question, because obviously we're thinking long term, and there is the increase in efficiency of these sorts of financial tools over the long run. However, when you think about it, when you're, especially if you're designing them in the way that you can add a lot of extra cash in, right, from the POAs, we've talked about this in prior conversations, that you can modify the design so there may be shorter pays, right? You pay in 10 years instead of, say, 30 or 40 or 50 years, whatever the situation, depending on how old you are. So you can design them based on someone who's older. And there's still tons of benefit around it, especially if the person is still young, still healthy, right? Because, people are living to 90s, 100 years old these days. And hopefully soon enough, that will be more normal. But so you just have to factor in that the design, there's definitely wiggle room of how you design them to account for how old somebody is and the time frame they hope to fund it.
Yeah, and I think time is the key consideration. Looking at those two circumstances, one is the death benefit, and that's only available when someone passes. Or someone's got a very, very deep sickness of some sort, depending on the type of policy. Sometimes terminal illness or critical or chronic illness will release death benefit proceeds for the insured if they can show that their sickness is such that it's part of the contract. But mainly death. And if you think about it, a newborn, as long as the newborn is healthy, $1 of base premium get you $80 of death benefit or something like that, because the life expectancy is into their 80s. Whereas for someone who's 60 years old, well, you're going to have to pay to get $20 of death benefit, you'll have to pay that dollar. So 4 times more expensive, maybe even 10 times more expensive, because your death expectations are not that far different in terms of age as that young child. And so, of course, death benefit becomes much, much more expensive as you get older. However, cash value becomes useful within 2, 3, 4, 5 years. And it's the same whether you're young or old. So the cash value, the IBC power of available cash, definitely looks a heck of a lot more similar between a newborn and someone in their 60s than the death benefit as a percent of premium. Does that make sense? Did I go too much?
Absolutely. So yeah, and that's why it's so important to work with somebody to help, because these things can be designed very uniquely, and this is where it's important to factor in kind of where someone is and what they're trying to achieve with their broader financial life, right? This is a component that really can hopefully accentuate what people are trying to achieve for their families or communities, whatever the situation. But, there's a lot of ways, and you got to get someone who actually knows how to sort of design them to match what it is you're trying to achieve. So There's a lot of flex. So, that's kind of where I'd like to leave it, because but it is a viable strategy for someone who's older. Don't think if you're listening to this and you're older, don't feel like you've missed the boat, especially if you're still healthy. And even if you're not healthy, you're able to create these policies on someone else's life, right? So this is another thing to also factor in. You can create policies on someone who's younger or healthier or in situations. So there's a flexibility in that nature as well.
Yes. And there is some difference in the cash value growth. The younger people are going to get that 5%, 5.5% illustrated growth. Whereas if you're buying one of these policies in your mid 50s, 60s, it's going to be more like 3% per annum. But again, the power of IBC is the access to that cash and the usefulness in times and periods in which opportunity or emergency is most profound. So in both cases, it just works exactly the way it illustrates. It's just that when you're older, you get a little lower return because the pool you're in is going to definitely suffer more on the death side, including yourself. It's still a low probability if you're in great shape, but older people are going to 1,000 old people are going to have more deaths in a year than 1,000 15-year-olds for sure.
Absolutely. So this kind of dovetails into kind of the final topic. I think kind of touches on this too, especially as we're kind of thinking about the wealth transfer. That there's this concept. If you get into IBC and learn about it, it's called the MEC rule, and that does impact policy design. And there's a lot of history behind this that we can briefly touch on. But the MEC rule is something to be mindful of as you're building your IBC system and policies in place. There are some reasons to have policies MEC, but for our purposes, for the use of the dollars and the tax advantages of them, we try to avoid that. So, Chris, do you want to kind of explain the MEC rule and a little bit about the background on it?
Sure, absolutely. So, before the 1970s, early 1980s, a really wonderful tax-sheltered investment for people with extra money was real estate. So you could do a tremendous amount of tax-effective investing in real estate, and that proliferated throughout the country. And when the inflation of the 70s came into play and real estate really accelerated in value, it got the eye of the IRS and the administration, specifically the Reagan administration. And they saw that too much potential tax revenue was being sheltered by these real estate partnerships. So they ended all that with the tax law of 1986. And actually, it might even be earlier than that, in the early 1980s. And so people were looking for other ways in which they could put their money that would give them, some growth without as much taxation, because tax rates were very, very high back then. And some bright people came up with the bright idea of using something that was tried and true and had been around for many, many years, even a century, and that's whole life insurance. But back then, there was no specific rule about how much you could put in as a percent of what your death benefit would be. And so people would do single premium life insurance policies where they'd put in a single premium, $100,000, and buy $150,000 death benefit or something like that. And now that $100,000 would grow tax-free throughout that person's life and then pay tax-free to his loved ones, his beneficiaries. And very quickly, the tax authorities saw that this was going to take a lot of money away from traditional assets, traditional stocks and bonds. And so they passed a law. I believe the acronym is TAMRA, or is it TEFRA? TAMRA. And what TAMRA said is, you've got to keep your premiums under what's called a 7-pay rule. So your premiums over 7 years had to keep a large enough death benefit as a factor above those 7 years of premiums such that you would get the life insurance treatment and tax-free growth. Basis in can be the first thing you remove, and any loan is a non-tax event. So those three things were the things that the IRS wanted to slow down the growth of. But as long as you follow that 7-pay rule, you get all those same exact valuable attributes of life insurance. If you violate the 7-pay rule, for example, the single premium policy, which don't exist anymore for this, well, they do exist, but they get treated not as a life insurance contract, but as a modified endowment contract. So they will be taxed to the extent, not in death, but they will be taxed as they grow, and they will be taxed if you pull from the policy either the basis that you put in or through a loan. You will get a tax 1099 that very year that you do that. So there are some uses for it, which is beyond the scope of today's conversation. But for me, 100% of my work with clients avoid the MEC, the modified endowment contract, and make sure that the life insurance we're helping our clients to obtain do not get the negative tax treatment that was created back in the 80s by the Reagan administration to avoid everything going into life insurance that needed to find a home that wasn't so heavily taxed.
Yeah. So in the end, though, the benefits, especially around taxation and use of the dollars, and can still be preserved. It just takes a little bit more attention to ensure that you're not overfunding it to some level where it turns into a MEC. So this is where you get the help advisor to monitor that and make sure you're contributing not above that amount. And, unfortunately, if it gets to that point, a MEC, it kind of almost has a lot of characteristics of qualified plans like IRAs and 401ks in terms of taxation. So it is something to be certainly mindful of, but, with the right advisement in place, it shouldn't be an issue for most clients. It's just something to be aware of. And, but still maintains a lot of the tax sort of benefits that are inherent to life insurance. So we just have to play by those rules, and things will just work out fine as it relates to IBC.
Well, and it certainly brings up that question that we hear a lot in our work, in our practice, that whole life insurance is not a great place to put wealth. Well, wait a minute. How is it? Why is it that the IRS restricted the amount of money that you could put in to a contract such as that without tax ramifications? And the answer in my mind is it's a very good place to put a portion of your wealth, sometimes even a large portion of your wealth. And it was fully recognized by the majority of the people in this country in the 1980s. And that tax law change, that TAMRA change, was not something that people wanted. And it shows me that this is still and will always be a very good place to store wealth from a growth and tax standpoint. And you get that partnership also with a large financial institution that's got your best interests in mind. So a little plug there, and just kind of the idea and the thought that if something's not good for you economically, why was its access restricted so dramatically 40, 50 years ago, 40 years ago?
No, it's a really good point, Chris. And it's one of those, sometimes you listen to folks like a Tom Wheelwright who kind of share this very frequently, that the IRS incentivizes us to do certain things, and there are substantial benefits around life insurance from a taxation perspective, and it's a good thing because we're protecting families, we're making it less incumbent upon the government to take care of families that couldn't fend for themselves wealth wise, and so there's a lot of benefits that are just come with life insurance, and you're sort of like partnering with the IRS in that sense. They're going to give you breaks on this because you're doing the responsible thing by taking care of your family in case of someone passing. So it's just that's just a different angle, a different perspective. I think is eye-opening to a lot of people, but just kind of the way the system works today.
Well, and it reminds me also of something you've told me and I've learned from you, and that is for a given death benefit, the insurance company decides what your minimum premium must be, and that's depending on your health and your age. But the maximum you can put in for that same death benefit is not determined by the insurance company, but the IRS. So they're defining the upper range per death benefit dollar, whereas the insurance company, based on the probability that they may have to pay a claim, they determine the minimum. So that's what you have on either side of that. And we tend to work in IBC, towards that upper range of where the IRS says, hey, that's enough. That's no longer a life insurance contract, because we do see the value there, the value of those dollars growing in a tax advantaged environment.
Wonderful. So listen, I know we covered quite a bit today, and obviously we didn't go, this is where it hopefully gives you a good starting point to understand how IBC can really help with transferring wealth to next generations, help them get educated about being responsible stewards of wealth and use of it, and some of the particulars around, whether IBC is suitable for older people, and even some details around MEC and sort of the rules around that we just need to be mindful of when we're using it. And so the next episodes are going to get into a little bit more practical use of IBC for business owners, which there's a ton of different options on how it could benefit business owners. And then we'll go into sets of episodes that talk about it for those who are not business owners, just in your personal lives, and how IBC can impact yourselves, your families, and your wealth. So I appreciate everyone listening and staying on our path here of explaining the foundations of IBC, and we'll look to see you on the next episode, episode number 8.
Looking forward to it, Tom. Thank you.
Thanks, Chris. Thanks for listening to this podcast, and hope you're enjoying this series on the infinite banking concept. Next up is part 8, IBC for the business owner. In addition to the podcast, I would highly encourage you to get the book, Becoming Your Own Banker by R. Nelson Nash. If you want to discuss how IBC can enhance your financial life, feel free to book a free call with our team. We'd be more than happy to help. Visit perennialpride.com to book your call.